One of the biggest handbrakes on a growing farm isn't the quality of the land or the skill of the operator, it's the finance. Most producers are sitting on a massive, untapped asset that could fund their next expansion, but they don't even know how to access it. To break down exactly how this works, I'm joined by Richard Brimblecombe, CEO of Legacy Livestock. Before this, he was the founding CEO of Stockco Australia, where he helped fund the purchase of over $1.4 billion worth of cattle and sheep across more than 1,500 producers. He's also held senior roles at CBA, Suncorp and Landmark, and grew up on a grazing property in southern Queensland. In this episode, Richard and I are going to break down how livestock finance works, how you can use it to grow your operation, and the biggest mistakes to avoid. Welcome to Dollars in the Dirt, Richard. Richard, what is the difference about livestock lending compared to your traditional bank lending? Where do you see the difference in the market for the livestock lenders?
Yeah, I think livestock lending in some ways is the inverse of traditional bank lending. So, when you've got a term loan from a bank, you want to take a conservative approach, you want to be very clear about serviceability over a long run through a number of different seasons. And the absolute worst case scenario is if you're selling the family farm to recover the loan. So you want to be cautious, you want to be conservative, and you want to be careful. And I think that's important. But on the flip side of that coin is if you've got a progressive farming family who are looking to grow, they're looking to provide a bigger asset to share amongst the next generation that's coming through, sometimes that approach can be quite restrictive for them, particularly if their appetite for risk is a little higher, despite the fact that they might have a good business. And so livestock finance is the inverse in the sense that we're going to agree to fund an asset, and the primary way out is the sale of the asset that we're funding. That's why I say it's the inverse of bank lending. So it really is asset-backed financing, but it's really a means to helping good quality farming families accelerate the growth rate in their business. So they can, if they've got a property, they have a good relationship with the bank, they're well supported by the bank, but they can't quite get enough working capital to fully utilise the productive capacity of the property. That's where a livestock financier can come in without disrupting the banking relationship and offer additional working capital to make sure that they're maximising the return from their farming asset base.
Yeah, and how does livestock funding work? Can you explain basically how you guys fund the cattle or the sheep, and how does that mechanically work from a producer's point of view?
Yeah, so from a livestock producer's perspective, Brecken, essentially we're providing an overarching finance limit, so let's call it $500,000.
Yep.
And once that limit's documented and put in place, generally speaking, the only security will be PPSR or personal property security registrations over cattle or livestock only. And once those registrations are in place, we're able to start funding clients after we've done, we've documented the facility. And the way it works is the client purchases the stock, they send us the invoice, and we will settle that invoice directly with the vendor or the vendor's agent in full and draw a loan against the client's facility or the producer's facility to settle that invoice. And then if it's trading stock, that facility or that loan will run until the stock is sold. And then when the stock is sold, the proceeds come in and they're used to repay that loan. If it's breeding stock, then there might be monthly interest payable and then quarterly or 6 monthly or annual principal step downs.
Yeah, and so you guys will fund all sorts of stock. So tell me about the type of livestock that Legacy's prepared to finance and what you might choose not to finance.
Yeah, sure. So we fund a really broad range of stock, and the stock we fund is really determined by our clients. So we try not to be restrictive in our approach. So what we're interested in is backing good quality operators that are running good businesses and good assets, and then we back their judgment regarding stock class. So if they're running a backgrounding operation and they're funding backgrounders, that's really easy. But if they see an opportunity in the market to switch to a cow and calf trade, for example, and split the cow and the calf and sell the calf separately as a weaner and go around again with the cow or sell her as a fat, we're happy to do that. We can accommodate that. If clients wanting to switch into a heifer trade and join them and sell them as PTICs, we can do that. So really, we let the clients drive the trade. We back their judgment, and what we find is that our money flows to where the best risk risk-adjusted returns are in the context of each client. So they're assessing the risk, they're making the decision about which is the best stock class, and we're backing their judgment.
Yeah, so effectively you're just giving them the capital to grow their business. That's the way that I see the livestock funding model helping, growing businesses.
Yeah.
And tell me, examples where you've seen businesses be turned around, like with the assistance of a livestock. Personally in my finance business, I've seen a lot of businesses that have, probably struggled for that capital to, they've got the season, they've got the grass, they see the opportunity in the market, but they just don't have the funding to take advantage of it. And you'd have a lot more examples of that than I would, but tell us a bit about that if you can.
Yeah, so look, typically we're only funding good quality producers that have got good relationships with their bank, but can't quite get the flexibility or the quantum of dollars from the bank that they need to optimise their business. But we've got a couple of really good examples of people that have really been breaking even, just struggling for a very long time. The bank's very well secured, they're comfortable, they're not giving them any more money, and so they're not able to break out of that kind of break-even position they're in, and they're the only thing that's missing is some extra capital to utilise that that unused capacity in their business. And so we've come in, and there's a couple of really good examples since we've been up and running where we've provided funding on top of the bank capital for people to dramatically increase numbers. It might be that they've had a really favourable season and they want to make the most of it, or that they have simply been operating well under the carrying capacity of the property for no other reason than access to capital. We've provided that capital. The income has significantly lifted on the back of that. People have made good quality decisions. They've bought good, they've made good trades. They've made good profits on the back of using our capital, and they've rolled that through. And, unfortunately for us, and it's a bit bittersweet, but 2 years down the track, the banker's looking at their numbers and going, gee, you guys are shooting the lights out. We'll give you some more money now, and we get replaced. And it's bittersweet, but we're actually cheering those clients on because we've actually helped them get to a different place, and that's where someone like yourself with your business can actually step in and actually secure that finance then on better terms in the longer run.
Yeah, and that's success, is if you can help those people to become a lot more profitable and they can grow, and eventually they might come back and buy another property and they need your assistance again. I think that's a fantastic story, and I know personally I've got clients that look at the assistance that the livestock funders have provided to actually turn their businesses around and get them into a lot better position. Often the banks don't probably view the livestock funders, they often want to take them out as quickly as they can. I have a different view. I think it's as we just talked about, that really the livestock funding complements the banks and makes the client overall assist them to be more profitable. Where do you see the relationship between the livestock funders and the banks?
Yeah, so look, I think we are somewhat misunderstood by the banks, and I think your average banker kind of views us as a competitor that they just want to get out of the way.
Yeah.
And we are never going to compete with the bank. We don't do overdrafts, we don't do term loans, we don't write equipment finance, those sorts of things, and we have no desire to. We're very clear about what we do. We think we're pretty good at it, and so we're very focused on the livestock piece. And we have structured our business in such a way that we don't take mortgages. We take a PPSR security over the livestock only. We're not disrupting the security relationship that the client has with the bank. So we don't want to disrupt that relationship. We respect that relationship, but certainly we think that there's a valid place for us to be there. And, we've got some very, very high quality clients, very low levels of gearing. The bank could be funding what we're funding, but they're clients who are looking to acquire another property in the near future.
Yep.
They're wanting to keep their powder dry with the bank, and in the meantime, they're using us to maximise the turnover from their business and the profitability.
Yeah, I think that's a really good point, and I often get asked the question from younger producers, like, how do we get a start in the because properties are worth so much these days, and it's just hard to get that deposit together to buy a property. And tell me, I think that you can use the livestock funding as a way of leveraging the existing herd potentially. Where do you see that from a young producer's perspective, trying to get started in the industry?
Yeah.
How can Legacy potentially help those sorts of producers to get started and to build a herd to then use as a deposit to buy a property?
Yeah, I think it's a great question, because one of the big challenges for young people in ag is if, I haven't been born into it, how do I get into it? And we're actually working with a young couple at the moment, on this exact same issue. They've worked really, really hard. They've actually got a deposit together to get into their first property, but the bank won't give them any capital to buy any livestock. And so, we will come in, the bank will have the first mortgage, we won't take any security over the property, we'll provide funding for the stock, and we'll get the cash turning and the cash flowing in their business. Now, because they're a young couple and they're starting out, they've actually got external income to service the bank debt on the property, and the stock debt will essentially service itself. It'll be self-servicing as they turn the stock over, generate the profit. So we only ask for trading stock for the principal to be repaid when the stock is sold. So you're not having to meet a repayment out of cash flow in the meantime. And I think that for a young person, who's cash flow poor but good at what they do and has proven themselves, livestock financing is a good way to get the numbers building and then reinvest the profit in more stock and keep building the numbers until you get to a point where you can say, well, actually, I can sell down some of these stock potentially to fund a deposit on another block, or simply go and lease a block or just a block, get the cash flow up, get the stock numbers up in preparation for another purchase down the track.
Yeah. The other way to look at that also, I think, is like, in the past, you and I have done some work together around, people that have got big herds and then looking to expand and buy land, extracting that equity out of the herd to use as a deposit for a land acquisition. Tell me, is that a common thing you've seen in the market, or you guys have been, part of those sort of transactions where someone's got a big livestock herd, they're short on equity in terms of cash or deposit for a property purchase. How do you see that working where we could use that herd to extract some cash to make that purchase?
Yeah, we think it's counterintuitive if you've established a herd to then have to sell. It takes so long to build the genetics, to build the numbers. You've got something that's in a joining cycle. Everything fits your business. We think it's counterintuitive to have to sell that down to come up with the money to buy a property, and then immediately you've got an income hole because you've sold those stock down. And so there have been a number of occasions where we've actually advanced against stock already owned, which has been sufficient to get a client a deposit on another property that the bank has funded, but they haven't actually foregone the momentum of the cash flow because they've still got all of their stock flowing through. And there's been some really good case studies that we've been involved in, and some with you, where clients have been able to acquire another property without diminishing future earning capacity as a consequence of us advancing against stock. And we really like those transactions.
Yeah, I think and it's the cost of putting that all together is massive. To get the herd together, to then go and deplete it, to then start again to rebuild it, just doesn't make any sense. And I think from a traditional bank funding point of view, the banks don't really they look at their stock mortgage and they extend a value on the stock mortgage, but they don't think, well, can we use that to then help them grow their business, which is, I think you guys play a really big part, and it's probably something that people need to, it's a bit different thinking to what traditional bank manager, and a bank manager is not going to put this to you and say, how about you talk to these guys? You sort of need someone to bring that together, to make that deal happen, and using a few different financiers to make it happen. But tell me, the traps, there's obviously, we're talking about all the positive stuff here, but there's also, and I've been, trades don't always go as expected, and people often say to me, well, what happens if the cattle market drops, or it doesn't rain, or, agriculture is there's so many variables and risks involved. Tell me, from a livestock funder's point of view, when things don't go as expected, how does that often play out? And tell me your experience in that space as well.
Yeah, and look, if you cast your mind back to, say, mid-22, the market was near an all-time high. The Equine market was at a near-time high. And, seasons were pretty good. The outlook was good. And the market came off. And then the forecast started to suggest an extended dry, and the market came off further. And so we actually saw the biggest fall in the Equine in its history. It's about 70% in about a 6-month period. So we had a number of customers that had bought stock, had added value through weight gain, but were either just breaking even or were actually trading at a loss. Now, our view is with those customers, if they're fundamentally of good character, they've got good equity in their overall business operation, they're good managers, the circumstances that have arisen is through no fault of their own.
Yep.
It's a market-related thing. They've been communicative with us. They've kept the communication lines open. The sensible thing we can do in that situation is work with those good quality clients and take that loss, put it to one side, and get them back into the market at a very low level.
Yep.
Because in all probability, there is going to be upside and you'll pick it up. Now, what we find is that the losses, they tend to be minimal because there's been this offset from weight gain in that scenario. And, our analysis indicates that essentially, even if the market falls 40% in the course of a normal, say, background of trade over 6 to 9 months, you are still probably going to make a small profit or break even after paying interest to your livestock funder. So there's got to be, if you're a good operator and you've got good quality pasture and you've bought reasonable quality stock, things have got to go really bad for it not to work out. Now, having said that, I think, the issue with debt is amplification. So debt amplifies outcomes. And so if things are going your way, it amplifies the profit.
Yep.
If things are going against you, it will amplify the loss. And so, and this is why we do tend to focus on well-established farming families that have got sound equity in their property and are good managers, because it makes it very easy for us to be supportive in difficult times and help them through to the better times.
Trade through.
Yeah. So we do think about it as somewhat of a cycle, and we tend to look through the cycle and try and position ourselves to work through those difficult times in a very pragmatic way with our clients.
And the character piece obviously has a massive impact on that. If people are prepared to work with you guys, you guys, I'm sure, are happy to work along with them also. And probably from my experience, the people buying the small stock and growing them out often seem to get through. It's when you buy those, the PDICs and trying to grow them out and sell them as a cow and calf is where I've seen the bigger issues happen. So do you agree with that? Is that's sort of when you're buying that more expensive article and trying to trade into another class, that's where often the problems come?
It can be. I mean, the context is different for every trade and for every individual, but I think if your trade is longer term and you're sort of trying to trade across classes, then you introduce new risk and you're introducing what we would call tenor risk. So the longer you're exposed to the market, the greater the probability that you might encounter something adverse in the market. So if you're engaging in shorter term trades, you're less likely to be impacted or materially impacted by that market risk. So, look, we leave those decisions to our clients because they know what's best for their operation. But, I think as a rule of thumb, those longer term complex trades carry more risk.
Yeah, definitely. Changing gears a bit, so back to the younger farmers. So, like as a younger producer starting out, what are your thoughts around how they should get started in the industry? You've had a long history in the finance and agricultural industry, and I'm just interested in your perspective on, I get asked a lot of, every week people are asking, how do we get started in this industry? We love it, but it just seems like it's so out of reach to be able to get started as a young person in ag if you're not born into it. So I'm interested in your thoughts on, what do you think a young producer starting out should look to do, and how to grow to get to a point where they can own their own property potentially at some point.
And I think firstly, it's a long road, and so you've got to have a lot of perseverance and resilience about you. You've really got to want it, and you've got to be prepared to see some pretty tough times on the way through. But I think it's about a series of steps in a plan to get to a different place. And so if you've got some sort of income earning capacity, it might be you're working off farm, or you're working in a mine, you're working in a local engineering shop, whatever it is. If you've got some external income and you've got some savings behind you, you can potentially get some adjustment. Get a lease block, get some stock flowing, start to get some cash flowing and build some equity in your livestock, and then, progressively over time, leverage that and get yourself to a point where you've built the cash flow. Then you can start to, save some cash and get some cash behind you progressively to get you into your first place. And, I think young people who are moving forward quickly tend to have got themselves into their first place. It may not be a big place, it's manageable for them, and then they're leveraging sort of that infrastructure that they're slowly building by adjusting or leasing some more country, pushing their return up, by getting that leverage of adjustment or leasing, and then starting to use an organisation like Legacy to actually start financing the cattle on that lease block or adjustment block and leveraging it up. And, it's just lots and lots of little steps. And sometimes it'll be 3 steps down and 4 steps forward. And, as I often say, unfortunately, when you get a shock, it's often down by the elevator and up by the stairs. So, you'll take a shock and you'll take 5 steps back, and then it'll take a long time to progressively get back to where you were and then move ahead. So you've just got to have that, you've got to recognise that that's what you're in for and be prepared to work through that.
I take out of that cash flow is probably the key to when you peel it all back. If you're a young producer starting out, cash flow is probably the number one thing you need to really. So having an off-farm job, or and then the next thing is getting some sort of asset behind you. So buying a house, and to get a livestock funder to assist a young person to grow their business. You sort of, one of your criteria is owning an asset of some sort. And so tell me, if I don't own a house, if I was, I've got a good job, I want to buy a mob of cows, I'm still don't, is the opportunity there to, get a parent to be guarantor? Like, how do you guys view that sort of guarantees and that sort of thing with getting a start?
Yeah, so look, it is part of our credit criteria that either our borrower or someone that's guaranteeing the borrowing does have some equity in real estate. And that's really about ensuring that there is some skin in the game. If we're funding 100% of the purchase price, including the GST, which we do, then if you don't have something else at risk in the deal, then we're carrying all of the risk, and it's pretty easy just to walk away if things don't work out. And so, we do want to see people invested heavily in the success of what they're doing, and, to have something else at risk to encourage them to, work through those difficult times with us and get to a sensible outcome on the other side. So,
just quickly, if you're tired of explaining your operation to a new bank manager every year, only to get a one-size-fits-all deal that doesn't fit your business, we can help. At Seasoned Finance, we do things differently. We've got over 70 years of combined experience in agricultural lending, and we work for you, not the banks. We're the consistent expert team in your corner, fighting to get the finance that actually helps you grow, purchase the next property, and build your legacy. Don't leave money on the table. If you're looking at your next move or just want a second opinion on your current setup, click the link in the show notes to book a confidential, no obligation chat with the team, and we'll show you what's possible. Righto guys, now back to the episode. Let's talk about the cost of livestock funding. Like, it's not your traditional bank interest rates, and often the talk in the market that it's a lot more expensive, and that the livestock funders are taking a lot of the profit out of the deals and that sort of thing. But, the way I see it is that they're sort of enabling the producer to make a bigger profit. Like when you compare adjustment, say, to funding a mob of trade cattle on a livestock finance, I think if you actually sat down and do the numbers, 9 times out of 10, you're better off if the market goes with you. And like, obviously there's more risk, but let's talk about the rate and how you see that, and the justification for charging a bit more than what you would from a bank.
Yeah. So look, I think the starting point for answering your question, if you like, around costs is we don't take mortgages. We don't have the luxury of a bank. We're not secured by a mortgage, and so we don't have the protections that a bank has, and consequently, our cost of funds is materially higher than a bank. And look, to be quite honest, the vast majority of our clients are borrowing money from their bank at a lower rate than we can borrow it at, because they've got a mortgage to offer, and we don't. But the reality is that whilst our headline interest rate is higher, because we are offering to fund 100% of the purchase price of the animal. There's the repayment terms are flexible, so we're not asking for any principal repayments until the stock is sold. In the case of trading stock. And in the case of breeding stock, we're actually aligning the principal repayments with major sales programs in the client's schedule. There's a lot of flexibility and variability that actually minimises the cash flow impact. And so there's a real dollar value in that. But what we also find in a stable market, so where the market is, that you're selling in and buying in is reasonably similar, on average, our clients are earning $6 for every $1 of interest they pay us.
Right.
All right.
Yeah.
So, if you focus on the headline interest rate, you can talk yourself out of an opportunity that really exists for your business. But if you focus on what's in it for me after I've paid legacy, for example, then it becomes quite compelling if you're confident in your ability to deliver. And so I think, that's the context that we think people should think about it is what incremental income can I earn in my business that I otherwise couldn't earn if I wasn't using a livestock financier?
Yeah, and that's the thing. It's pure profit, really, isn't it? Like it's the way that you position it in, and like I say, if you compare it to say receiving $5 or $10 a week adjustment, in comparison to making the $5 profit that you're saying, like it's adjustments. It's dear when you're paying and it's cheap when you're receiving it. Like it. I think that if you actually sit down with a piece of paper and work it out, and have you guys done many analysis around that with comparing adjustment to what you guys, if on a typical trade?
Look, if I own country in a stable market and I finance cattle with legacy rather than take external stock in on adjustment, I'm typically going to earn about double.
Yeah, right.
That's the maths that we do. So it is very compelling.
Yeah.
And if you want to have control, if you want to own the stock, you're prepared to accept some market risk. But if the pasture's in front of you, you know what it'll do. If it's going to be doing 0.6 if your cattle are going to be doing 0.6, 0.7, maybe 0.8 a day, then you are going to outrun that interest rate many, many times over.
Yeah. There's not enough awareness around the livestock piece at times around the opportunity that it can to help you grow your business. I think there's at times people don't consider it as a viable option because they get scared of the interest rate up front, but they don't actually sit down and work it out in terms of how much money they potentially could make if they actually looked to use a funder like yourselves to do that.
And look, on an annualised basis, a typical crossbred steer in Queensland is growing at about 60% per annum in value.
Yep.
And that's doing about 0.7 a day. And, your typical crossbred lamb in the south is actually growing at about 120% per annum in value. Now, obviously, you're probably not going to hold it for 12 months, but if you annualise it, that's what it looks like. Now, if you're paying away, 10, 12% to us, then and you're earning 60%, the maths work out pretty quickly.
Yeah. And talk about the lamb. So you guys, like, there's no issues around the sheep. Like, you guys fund a lot of sheep as well. Is there anything that you guys like? Do you do goats and that sort of stuff, or is it just sheep and cattle? Or
yeah. So at the moment, we haven't funded any goats. We actually have the ability to fund goats, and it's in our credit policy. But we haven't funded any at this point in time. We will fund virtually any stock class of cattle, and similarly for sheep. So we do both breeding stock and trading stock. The vast majority of our book is trading or backgrounding stock. We've got funding quite a few lambs in the south that are being grain fed because it's been very dry down there up until recently, and there's been grain's been cheap, lamb's been high. There's been a real dollar in that, and people have kept generating income with minimal pasture on the back of those sorts of trades. So that's been good. We're doing dairy as well. So if you've got clients, and our focus in dairy is really around existing established operators wanting to buy another 100 cows or 200 cows or grow an existing business.
Cool.
We can do that.
Yeah. And where do you see the future of ag lending? Like, where do you see, the livestock funding piece has probably been on the scenes in Australia for the last 10 years, say, in the degree that it is now. Where do you see the future of this sort of funding going and the future of legacy livestock?
Yeah. Look, I think livestock finance is becoming very mainstream now. And I think, when I look at our portfolio of clients, the vast majority of them, are very well-established producers who've got really good quality asset bases and, enjoy the support of their bank, but can't quite get enough money to optimise the return from the asset base they've already got. And so that's where we come in. It's complementary or supplementary capital that enables them to really turbocharge their returns from their existing asset base and maximise the returns from their assets, which in turn positions them to go and expand and buy the next block and, go again. And so we tend to be funding those progressive producers. So I think, we're here to stay. I think we're a little misunderstood in the market by the banks, but I think we've got a very important role to play now. And if you look at, how long specialist livestock finances have been now in place in Australia, there's just this legitimate role to play supporting, good quality producers. I think in the early days there was a bit of a stigma around, you've got to be in trouble to be talking to a livestock funder.
Yeah.
Well, when I look at our clients, they are very good quality operators with good quality assets that are really looking to optimise returns, and they've come to realise that they can pay a higher rate to us and still materially improve the returns from their business.
Yeah. It's all about profitability, really, isn't it? And that's the thing. Like, I think the guys that really understand their business and their profitability see you guys as a tool to help them grow, and that's probably the point, isn't it? Is you're an enabler to growing businesses, and that's where I see the livestock funding really helps those businesses that are on a growth trajectory, buying that next property or taking on a lease block. It really helps them turbocharge that and get them to that next stage, really, isn't it? That's
Absolutely.
How, I see that's how it really happens.
We'll back them before the bank does.
You guys are a lot more, probably responsive, flexible. Like, talk to me around the turnaround times. If I needed to buy a mob of cows off Auctions Plus on Friday, how quickly could I get something in place, do you think?
Yeah, so look, we will generally turn any size application around in 48 hours.
Yeah.
So, because we're very focused, we're industry specialists, we understand the industry, all of our team members, are familiar with the industry. We are very clear about backing the judgment of our clients. So if they're of good character, good assets, sound equity, then we're going to be making a decision very, very quickly, usually 48 hours to get to a decision.
Yep.
And then 24 hours after that, or sometimes less, they've got documents in front of them, and the day after that they're trading. So we can turn it around in 3 days and actually have invoices settled in 3 days if we need to. Typically people are, getting an answer in 2 days. The documents are turned around a couple of days after that, and but sometimes we get a call from someone, and I can hear the auctioneer in the background. And we know there's going to be a sense of urgency.
It's fun, isn't it? Yeah.
But look, we do charge a higher interest rate, and we're very focused on providing a premium service.
Yep.
And so we think that's part of what you get when you deal with a livestock funder like Legacy, is you get that premium service, fast turnaround, a good understanding of what you're doing, and the ability to make those decisions quickly. So it's not just the initial trade, but it's very common for us to have a client that initially borrows $500,000. Then they figure out how much money they can earn from putting our capital to use, and how the structuring, in terms of, not having to make principal repayments, very flexible repayment terms that are aligned with when they receive cash. Once they figure out how they can use the capital to their best effect, often they're coming back and saying, hey, we'd like to increase our limit. Or another thing that happens is they'll have a $500,000 limit, they're drawn to $300,000, and a really good opportunity pops up for $300,000. So it's going to take them $100,000 over their limit. For us, that's a phone call. Just a call. We'll turn that around very, very quickly. Often, if if someone rings me and I'm familiar with the file, I'll give them an answer over the phone.
Yeah. It's sort of old school banking, really, isn't it? Like that old school service on what you used to get from a bank manager that understood your business. So exactly. I think it's and those opportunities, you need to take advantage of them there and there. A lot of the time, you don't have time to go back to the bank and say, I need an extra 100,000. And at times that can take a week or 2 weeks to get sorted with your traditional bank. So you guys have really got a niche there, being able to provide that quick service. I know the rate's a bit higher, but being able to take it, the profit that can be made from making the most of those opportunities, it's worth the rate every day, isn't it? Really?
Yeah. Well, look, I think the profits you can generate make the rates look cheap in real terms.
That's right. Yeah. And it's so what's a mistake you see people make with their finances across the board? Like, you get to talk to a lot of producers, a lot of good producers. Yeah. What do you think is a common mistake across ag businesses in general when it comes to finance?
Well, firstly, I'll give your business a plug, because I think the biggest thing that we see is people, they've got some bank funding. They've had 5 managers in the last 4 years. They don't really have a relationship with their banker, and they don't know how long their current banker is going to be around.
Yep.
And they're frustrated. So, as long as they don't want any more money and they keep meeting their payments on their current loans, there's no issue.
Yep.
But if they've got a dynamic growing business and they're wanting limit increases or more money to do something else, they're frustrated. And in my time, in my early days, in the ag banking industry, it was very relationship driven.
Yep.
And it feels very much less relationship driven now at the bank level, which is why I think businesses like yours have been so successful, because people can deal with you day in, day out, year in, year out. You get familiar with their business. They know they can rely on you. They don't have to re-explain everything every time there's a change, because you've got very stable team. So I think that's one of the big changes we've seen in the industry, is this movement towards brokers, and and good, very good broking businesses are focused on providing the relationship management that's no longer available from the banks.
Yeah, and that's the business that we sort of created, is effectively what a bank manager was 15 years ago. Yeah. We sort of filled that void where the banks have probably struggled in the last 10 years. Their investment into people probably hasn't been there like it was in the past. And the other thing is that we give people the options also. Like, we have access to Legacy, we have access to all the major banks. It just gives people, especially in regional and remote areas, access and distribution of these products that they mightn't usually be able to get access to in their local towns, which it's great having funders like Legacy that can actually, that are on board with brokers and helping us to grow our business, and helping the producers in the bush to grow as well, which is really important.
We're very much focused on a long-term relationship. So, I think there are some specialist livestock funders that are much more transactional in nature than us, but we provide a revolving limit that clients can transact over and over and over again within that limit. And what we want to do is develop an understanding of their aspirations, their goals, their business, how it works, how the cash flows through it, so that we can align, the funding to help them get the best effect from their business. And to do that, you've got to develop a relationship, and you've got to invest in that, in understanding the client's business and building an understanding of what they're trying to achieve, so that you can be part of the facilitation of that.
Yeah, and one thing I have found dealing with Legacy and the other livestock funders is Legacy does have probably a lot better relationship with the customer and understanding probably than some of the others in the market, which is, I think, is really important, especially when you're dealing in an asset that's can be here today, gone tomorrow. In terms of, there's a lot of trust there when you're financing a live animal. I think it's really good that you guys understand the customer and who you're dealing with, which is crucial to the relationship and the success of the customer, really. What are some of the things that producers should fix in their own businesses, do you think, before they go and apply for more finance? Is there anything that you see as a common issue?
Well, it's interesting. I mean, our focus is on backing businesses that are successful and growing in their own right, but are being constrained from a lack of capital. And so I think, sometimes it involves a change of mindset from a producer. It's like, okay, are we going to keep, operating in this constrained capital environment, which is minimizing the amount of profit or holding back the amount of profit we can generate from our existing asset base? And am I prepared to pay a higher rate for some supplementary capital that will actually generate far higher returns? Because what we see is that most producers are covering their costs, they're meeting their interest, and in some years they're shooting the lights out, and other years they're making a material loss, and in 3 or 4 years they're just breaking even. But when you get that good season like we're seeing in the Longreach district at the moment, for example, and there's a real opportunity to carry extra stock, people are often saying, well, I haven't got enough headroom in the overdraft, so I can't do it. And so they might take some adjustment on if they can get it. But the more progressive producers who've really, spent time, with the likes of yourself, understanding where the opportunities lie, understanding, what some incremental capital could do for them in terms of profitability. I think that's what they've got to do is really challenge the mindset around, okay, it's more expensive than bank funding, but what does that get me? And I think, we talk about progressive producers a lot because they've broken through that mindset and, they've unleashed a new level of profitability in their business that they haven't previously been able to achieve. So
yeah, definitely. And so tell me, for to get a yes out of Legacy Livestock, to I want to buy a mob of cattle. What do I need to do to show to you? Tell me just what does Legacy look for to get it to prove some money?
Yeah.
What do we need to do?
Yeah. So we're a bit like you, focusing on the big C's. So character, capacity, collateral, and cash flow. So they're the things that we really focus on. So, and the single most important one is character. We like to fund people that are well established in a district, been there for some time. Their name is important to them in their local community. So we know we can rely on them to really dig in, if things don't work out, and we can work with them proactively, and they'll communicate well with us.
Yeah.
So, that's number one. Number two, they need to, be able to present their statement of assets and liabilities. So, this is where a broker, I think, becomes very important, is presenting good quality financial information succinctly to us, which enables us to go through our credit process very, very quickly, get that turnaround in 48 hours. So it's like, am I of good character? Is your credit score sound? Can I present basic financial information in a succinct way? And can I demonstrate a plan? So what is my intent? What am I going to do with the money? What's the, people need to be able to show us what their intent is and how, or what trade they want to engage in, and what the plan is, so that we can make sure that we can align our funding with their business need as well.
Yeah, we talk a lot, in previous episodes on Dollars in the Dirt. I've talked a lot about understanding, having a clear plan on where you want to go is really important. If it's it's hard to sail a ship if you don't know which port you're heading to. So I think it's the same with you guys. If the customer doesn't know where they want to grow their business, how they want to grow, it's really hard to provide that capital to help them do that if they don't really know where they're heading. So how do they know? Like, if someone's out there listening to this and thinking, well, maybe I should look at putting a limit in place. What do you think they should do, and what should they have the ready to go to you, to come to me or to come to you to say, I want a facility to do this?
Yeah. So look, I think it comes back to a point we discussed earlier, where what is your plan? So be really clear about what you want to achieve, and what you're going to need financially to achieve that plan. And then really it's a matter of coming forward, using someone like yourself to actually put the plan together, articulate what you're trying to achieve, support that with relevant financial information, statement of assets and liabilities, last couple of years' financial statements. And we are very much a forward-looking organisation. So the historical financial statements for us are less important than for, say, a bank. They are very useful in validating what we see around the demographics of the business. So what's the annual turnover and what's the expense base and those sorts of things. So it's a good reference point for us, but our focus really is on the plan. What is the client trying to achieve? What is their strategy? Is that well articulated and well thought through? And are they clear about how much working capital they'll need to make that happen? So I think if they can talk to someone who can articulate that to us, get it down on paper and present it in a format that works for us, your team, in Longreach and further through Queensland, then I think that's very helpful, and it helps us to get to that decision much quicker as well. But essentially, if you're an existing established producer, you've been in business, more than 3 years, got an ABN and registered for GST, you've got sound equity in your property, you're supported by your bank, but not getting all of the money you want from them, then you're probably a good fit for us. I think the good point to make is that, if you're looking to get money from a livestock financier, basically compile what you normally would for your bank annual review.
So it's similar. So the information required for an annual review is similar to what a livestock funder would look for to get a limit approved. It's very much the same. And from our perspective, a lot of our clients, we have all the information together. If you're working with a broker, they should be able to have most of the information at hand to put a limit in place. So there's nothing additional or extra that a livestock funder needs that a bank wouldn't need for a review. So probably to recap on today's conversation, one thing is just making sure you've got that documentation really in order, your statement of position, all your documents together to present a really clear plan, not only for your bank, but also for a livestock funder. It's really important that we have that information up to date and accurate and are in a well-presented proposal to present your business in the most professional manner possible.
Absolutely.
Well, thank you, Richard. Thank you for your time this morning. It's been great catching up. Learned a lot about livestock funding, and you guys, play a very big part in the market in terms of helping producers grow. And I see the massive opportunity there for you guys to help grow the industry and keep the wheels turning. So thank you for your time, and appreciated catching up this morning.
No, thanks, Brecken. Really appreciate it. And look, we love working with the team at Season. You do a great job, and we always see happy clients coming through to us from Season. So well done on what you've done.
All right, thank you, Richard. Thanks for tuning in to Dollars in the Dirt. If you've got value from today's episode, make sure to subscribe so you never miss the insights you need to grow your business. And if you're ready to stop being just another number to the banks, visit Season Finance via the link in the show notes. Remember to follow us on socials, and catch you next time.